Howdy, everybody. Welcome to Liberty Call. Today is Monday, May 5th, 2025. Hope you're having a fantastical day out there in the interwebs. It was a beautiful day here. It looks like it's getting a little gloomy outside, so not sure what's going on there. So anyways, hope you had a good weekend, and we had fun here at the Dahlman homestead with our puppy. You know, got chewed on, peed on. So lots of good times. But Jake is showing him the ropes as far as being a deputy director of security here at the world headquarters of DSA Financial Group. So we'll see how he does. You know, would hate to have to take him out back and shoot him. So he's kind of cute. Anyway, that's a joke. I'm not going to shoot my dog. So, all right. May kicked off with a stumble as Trump slapped 100% tariffs on foreign films, sending media stocks reeling. Netflix and Disney slid, and Berkshire Hathaway took a 4% hit after Buffett announced he's stepping down. Oh my gosh. On the bright side, Skechers sprinted 25% higher on a $9.4 billion buyout offer, with all eyes now turned to the Fed's next move. So before we jump into all the news of the day and the markets and all that good stuff, I need some help from you. Yes, you sitting right there just picking your nose and scratching your butt. Give me some thumbs up, a like, share, subscribe, and follow, and press that notification bell. All right, let's, where are we going? Here we go. All right. Dow Jones finished the day down 0.24%, 98 points, closed at 41,219. S&P 500 up 0.62, or I'm sorry, down 0.62%, 35 points, closed at 5651. NASDAQ down 0.74%, 133 points, closed at 17,844. The VIX was up 4.01% today. It's at 2359. Canada down 0.31, Brazil down 1.21, and Mexico up 0.02. Headed over to Europe, Germany was up 1.08%. Looks like the UK was closed. France down 0.55%. Netherlands down 0.13%. Spain up 0.53%. Italy up 0.39%. Switzerland down 0.01%. And Portugal up 0.49%. Russian exchanges both red again today. The MOEX down 3.25%. RTSI down 3.75%. And the Asian markets, the Nikkei in Japan was not open. Australia down 0.97%. New Zealand up 0.08%. Looks like all the Chinese markets are closed. So we'll just skip all of those. All right. All righty. Well, let's get to the weekly economic update, see what's going on there. Stocks pushed higher last week as investors cheered the White House's constructive comments on trade, upbeat Q1 corporate reports, and encouraging jobs report. The S&P 500 index gained 2.92%. The NASDAQ rose 3.42%. The Dow Jones added 3% even, and overseas markets were up 2.56%. The longest winning streak in 20 years. During the first two trading days, stocks increased as investors responded favorably to White House comments on tariff deals. Then midweek, on the last day of the month, fresh data showed the economy contracted by 0.3% in Q1, the first decline in gross domestic product in 3 years. Stocks initially fell on the news, but staged a stunning recovery to add a seventh day to the S&P 500 and Dow's Industrials winning streaks. Q1 corporate reports from a couple of mega cap tech companies boosted all three major averages over the next session, with NASDAQ leading the rise. By Thursday's close, NASDAQ had returned to its pre-April 2nd levels. Let's see here. The rally accelerated on Friday as better than expected April jobs report eased some concerns about the economy's strength. Signs of a potential thaw in Washington-Beijing trade relations also boosted enthusiasm. The Dow Industrials rose for a ninth straight session, as did the S&P 500, its longest winning streak in 20 years. All right, solid jobs report. The April jobs report showed employers added 177,000 jobs last month, 34,000 more than economists expected. Still, it's not that many. I mean, give me a break. The report quieted talk about a recession, which was welcome news. The April figure also showed the economy was still adding jobs despite a sluggish Q1 GDP report. However, the strong report did prompt some traders to push out expectations for an interest rate adjustment until the Fed's July meeting. I think I said that a week or two ago. I must be clairvoyant. All righty. Key economic data this week. Monday, the ISM Services Index and the PMI Composite Final. Tuesday, the trade deficit and the FOMC meeting, day one. Yep, they're having a meeting this week on the 6th and 7th. Let's see here. Wednesday, the FOMC meeting day 2, Fed decision and Fed Chair Powell press conference and consumer credit. Thursday, jobless claims, productivity and costs, wholesale inventories, and the Fed balance sheet. And Friday, Fed officials Austin Foolsby will be speaking, John Williams, and Beth Hammock. And companies reporting earnings this week, got a bunch. Monday, today, Palantir, Vertex Pharmaceuticals. Tuesday, AMD, Arista Networks, and Duke Energy. Wednesday, Uber Technologies, Walt Disney, and AppLovin Corporation. Thursday is Shopify, ConocoPhillips, and McKesson Corporation. All right, so that is all the news that is fit to be updated for all you folks out there. All right, let's get to the market recap. SP 500 slips as traders await trade deals and the Fed meeting. The SP 500 declined on Monday, poised to end its 9-day winning streak as falling energy stocks and investor caution ahead of key trade updates and this week's Federal Reserve decision weigh on sentiment. Well, I'm going to go out on a limb here and say that they're going to do nothing. They're going to talk about how they're evaluating the statistics and all the reports and blah, blah, blah. And it's going to be a wait and see. I just saved you a lot of hand wringing and, whatever Chairman Powell's going to blabber about on Wednesday. All right. Energy stocks led the losses with ExxonMobil and Chevron both slipping after OPEC Plus announced it would begin increasing oil production in June. That pushes prices down. The move triggered a sell-off in crude with Brent oil futures down 1.8% to $60.22. Wow, that is quite low for Brent. The production hike by OPEC and its allies comes amid growing concerns about oversupply and weakening demand, further pressuring global energy markets. And if you remember last week, we talked about how the government was going to refill the SPR, the Strategic Petroleum Reserve, but they're having to wait because some of the salt mines had some damage, blah, blah, blah. Anyways, we need to buy oil. This is the time to do it. If prices are going to fall, let's refill the reserve. I mean, do we need a reserve? I don't know. I mean, there's plenty of oil in the ground, but anyways, where was I? Markets are bracing for major developments this week, with President Trump suggesting on Sunday that new trade agreements, quote, could very well be, end quote, announced in the coming days. Optimism has been rising, especially after China indicated it was open to discussions over Trump's 145% tariffs, which have been met with 125% retaliatory duties from Beijing. Investors are also anticipating the Fed's upcoming policy decision for clues on potential interest rate cuts. And in corporate moves, Berkshire Hathaway fell over 4% after reporting a 14% drop in Q1 operating earnings, largely due to insurance losses tied to the California wildfires. The company's shares also slipped on the news that legendary CEO Warren Buffett is stepping down from day-to-day operations. Meanwhile, Skechers USA shares surged over 24% following news of a buyout. The footwear brand is set to be taken private by 3G Capital in a $63 per share deal. Overall, the combination of geopolitical uncertainty, weaker oil prices, and key corporate headlines created a cautious tone to start the week on Wall Street. You should be cautious all the time when dealing with Wall Street because that's your money, folks. Don't put it someplace where it can get kicked in the balls. All right. Next up, got a data report from First Trust, April ISM non-manufacturing index report. Mr. Nate Guernsey put this together. So let's blaze through this and see what it says. U.S. Service sector continued to expand in April, showing no signs of a recession, according to the ISM Services Index, which rose to 51.6, beating expectations and signaling ongoing growth in the sector that drives 2/3 of the economy. Most key indicators reversed March's declines. New orders increased to 52.3, with many respondents noting a push to increase domestic sourcing and manufacturing. Business activity also expanded, though at a slightly slower pace, falling to 53.7. Despite this growth, service companies remain cautious about hiring. The employment index stayed in contraction territory for a second consecutive month, with equal numbers of industries reporting gains and losses. Respondents cited federal spending cuts and reduced grant funding as key reasons for hiring freezes. Well, if you're hiring people based upon money you're getting from the federal government, they're not really employees. Let's see here. Inflation pressures remained high, with the prices index climbing to 65.1, its highest level since early 23. 17 of 18 major industries reported paying higher prices, with only arts, entertainment, and recreation seeing a decline. With the Federal Reserve, while the Federal Reserve is unlikely to make changes to its interest rates at this week's meeting, future rate cuts remain possible in the second half of this year. Tariffs and spending cuts are creating headwinds, but for now, the resilient service sector is keeping the U.S. economy afloat. Right. So, yeah, well, we've gone from making stuff to just servicing and selling stuff. So that's kind of, that's the business I'm in. I provide a service for people. I don't actually build widgets or anything. But if the world falls apart, I might be, get some chickens and sell eggs. All right. Last up, the Monday Morning Outlook from Mr. Brian Westbury. This week's article titled "No Recession Yet, but Risks Remain." All right. Despite headline concerns, the U.S. is likely not in a recession yet. Real GDP declined at an annualized rate of 0.3% in Q1, sparking renewed fears, especially amid tariff uncertainty, falling stock prices, and ongoing political drama. But a closer look reveals the drop was primarily due to a massive surge in imports as consumers and companies front-ran Trump's new tariffs. I talked about that several weeks ago. Wasn't going to be a shock. I'm actually shocked that the GDP number came in as good as it did. I was expecting, -1, -1.5. But, hey, negative 0.3 is not terrible. Let's see. Trump's new tariffs. Since GDP subtracts imports, they're not domestically produced. The data gave a distorted picture. Key components of the economy remain strong. Real consumer spending rose 1.8%, and business investment in equipment surged 22.5% annualized. A core GDP measure, consumer spending, business investment, and home building grew at 3% in Q1, matching the annual trend. Meanwhile, non-farm payrolls rose 177,000 in April, with an encouraging shift towards private sector job creation rather than government-driven hiring. Well, the government-driven hiring does not help the economy because you have to steal from people like me to give to these government workers. I call them people in adult daycare. But the private sector is the only place where tax revenue comes from. If you work for the government and that you pay federal taxes, you're really not helping. Industrial production and manufacturing also expanded, rising 5.4% and 5.1% respectively. This mirrors a similar GDP dip in early 2022 that wasn't recessionary. However, recession risk is elevated, estimated at 40 to 50% over the next year. The delayed impact of monetary tightening combined with a dramatic reversal in fiscal policy, especially the Trump administration's 32% proposed cut in non-defense discretionary spending, could eventually reveal economic strain previously masked by massive deficit spending. Tariff uncertainty adds further drag. Import activity has slowed and businesses remain hesitant to reshore operations without clarity on trade policy timelines. Bottom line, the U.S. economy hasn't tipped into recession yet. Storm clouds are forming. Investors should remain cautious as tighter monetary and fiscal policy combined with geopolitical trade risks to pressure future growth. All right. So sounds like Mr. Westbury and I are kind of on the same page. So we're not there yet. He's a little more tepid. Granted, he's putting this out in a written document. So he's got, can't just say, well, I think this is going to happen because if it doesn't, then, or this is definitely going to happen, because, if it doesn't happen, then he's, his own reputation's on the line. All right. Well, that's everything that I had to cover for today. If anyone needs to get in touch with me because they want to get their financial plan in order, where do you go? DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'll be glad to help. All right. Well, I hope everyone out there is having a wonderful Monday, and I'll talk to everyone again next time. Adios.